Keep calm. And carry on buying AI tech stocks as they deviate from the highs. Where the greater the deviation, then the greater the buying opportunity presented. Keep calm and carry on buying. Quantum AI tech stocks. This is an update for my stock market trend pattern for 2022 in advance of my extensive analysis of the US housing market full spectrum analysis, which this context list gives an indication of the extent of 3 months in the making. Of course, that is first going to be made available to patrons who support my work. So do consider becoming a patron by supporting my work for such in-depth analysis that concludes in a detailed 3-year trend forecast, as it did for my UK housing market analysis in early April. So the stock market bounced, fizzled out at 41.80. There's no break above 4200 to target a trend to 42.90, let alone anything higher. And one does not need to look far for the culprit, which is CPLIE of 8.6% for April, as the consensus and likely the Fed had convinced themselves to expect inflation to have peaked, hence triggering a whiff of panic as to what the Fed will do next to combat inflation. Remember folks, this analysis was first made available to patrons. My stock market big picture remains to expect the Dow to target a trend towards a probable bottom, maybe not the bottom, but a bottom late August, early September at approximately Dow 29,600. This has been my objective since January. Go back and read my analysis for mid-January, late January, and I gave indications of that the Dow was targeting a trend to between 30 and 29k, with the most probable price point being 29,600. So far, the stock market has done nothing to negate this scenario and thus remains the direction of travel ahead of my next stock market in-depth analysis, with the Dow closing Friday at 31,393, which is 1,800 points. Again, this was made available to patrons some time ago. Some 6% away from target, which implies that the current sell-off should terminate some points above 29,600, resolving in a summer rally ahead of a target low. Again, looking at the more popular S&P index as requested by my patrons. They want me to look at the S&P, which I do trade along with the Dow, but in analysis terms I tend to focus on the Dow since I have been analyzing it since the mid 1980s. When I Dow, well, I'm digressing now. Dow data going back to before the start of the 20th century, whereas S&P I think started around the mid 50s or 60s, something like that, so not much data. Anyway, there was no internet then, and I got my Dow data actually out of a library book and I fed it in by hand. The unfolding pattern suggests the S&P is targeting a trend to first support zone of 38.75 to 38.25 and will likely break, given that we are in a bear market, to target a trend to a new bear market low of 37.30 before embarking on the next bear market rally. Who is it? Is it hot? Very hot. You look like a brown. Target trend to a new bear market low of 37.30 before embarking on the next bear market rally that will once more resolve in a trend lower to target 3600 by mid to early September for the target bear market low. Don't know, the target low does not mean the final low. As I expect what will follow, the low will be a base building exercise that will likely see several false spikes to new bear market lows as a volatile trading range that will seek to confuse investors, most of whom will become convinced by the crashes coming brigade. You've seen them shifting the blooming nutcases. They all crawl out of the woodwork when stocks trade to lows. Who's crash going? It's the end. The depressing 930, 973, 495. They don't have a clue what they're doing. They're just selling fear. The crash is coming, brigade. Will paint the picture that becomes so bad that a big crash will be seen as being inevitable, and thus many will throw in the towel near the bottom, perhaps on one of the trading range rallies, to sell just before the stock market enters into an inexplicable powerful bull run into the end of the year, after having shaken off all of the weak hands during a couple of months of chaos that will leave many, it's really frustrating, I tell you. I get comments, oh, the stock market is down today. Is he going to crash? Oh, the stock market, is he going to go bull market? Come on, there's noise. Daily price action is noise. Even 5% movements are noise. Just focus on the big picture. So all those who sold will be desperate for another sell-off to buy back at the lows, so they can have another chance at buying at the bottom. After all, that's what's the stock market pattern for the preceding 10 months. Thus, whilst 29,600 is the target low, however, it will have to break several times during the subsequent trading range to create the necessary conditions for the subsequent bull run. It's what happens during the accumulation phases of the market. We had the distribution phase, which was, I would say, the last 4 months of 2021, and now we're going to have a accumulation phase, which will probably last from mid-August to early November. That's what happens. And during that phase, you get volatility, you get up and down spike up, and you're going to get a lot of people banging their heads. They're going to be selling at the top, and they're going to be selling at the bottom and buying at the top of the range, and it will just wear them down. That's what happens. So the low will have to break several times during the subsequent trading range to create the necessary conditions for the subsequent bull run. Though, as per my last in-depth analysis of the stock market, which was in September 2021, the presidential cycle suggests that the Dow will end down this year, which is what I said nearly a year ago now. The trend pattern, as this excerpt illustrates. So my next in-depth analysis of the stock market will conclude in a new detailed trend forecast into 2023, but for the time being we are meandering towards Dow 29,600 by late August, which will be followed by a volatile trading range that could extend into the end of October. As my Dow chart that roughly illustrates the trend picture I have in mind, that of course is pending in-depth analysis, because first I need to get the US housing market done, and then I've got this, but I think I'll do the stock market after I do the global housing markets. Otherwise it's going to be months, so that's what I will do. What about Chinese stocks? Have they bottomed? They're finally showing signs of having bombed. So what not to do is to stop bailing out on 20%, 30% run-ups. That's what the weak hands do, but instead take a breakout above, say, baby Baba 140 as a sign of the start of a multi-year bull run towards new all-time highs. Alibaba at 110, P19, EGF minus 12%, EGF 40%, implies strong future earnings growth, though the next quarter will probably be peak, so you might get a dip towards the lower end of the range, around 90, maybe even lower. So, but future earnings growth looks strong, which will lower multiples and thus inflate the stock price. So forget technical analysis, fundamentals. Investing all boils down to investor psychology. Here's a test. If you are invested in Baba and say you have a 30% drawdown, as do I at 110, and how do you perceive your Baba holding? Are you eager to get out on a smaller loss or even break even, or did you throw in the towel as Charlie Munger did? I think he's going to see now. By selling half his Baba stake at around $100, he made a significant loss. Me, I'm holding for $600 a share, which means all those who have been weeping over a 30% drawdown in Baba or worse, sold near the bottom, don't understand stock market investing. Most will sell near the bottom because that is when the fear is at its worst. For instance, in March 2009, the masses had been convinced that we were heading for a rerun of the 1930s depression. After all, CPI was negative, so they thought it was going to be a deflationary depression. So who in their right mind would be buying stocks that were heading towards zero? Not many did, nor would they for the next 5 years. Only to FOMO towards the tail end of the last bull market. And that's what it's like at the bottom. Most have had enough and given up and are eager to get out as soon as they can on any rally off the low. That is investor psychology. They get pummeled during the accumulation phase when it's volatile, spiking down to new lows, and they think worse is coming, and they got the crash is coming brigade at their most vocal. They get pummeled to exit on nothing rallies, and then some years later they pick up, they look at the stocks and go, what the hell, I should have bought in March 2000, why did I sell? Because the idiots were telling you to, the blooming depression crash is coming. Understand? The fear commentary is at its worst at the bottom, while optimism at its highest at the peak. Which is why, you're only gonna condition your brain by having lived through multiple bull and bear markets where you become immune to investor psychology. I automatically do the opposite. I was selling last year. Go read all my articles from June to December. I was selling, reducing my portfolio ahead of a probable bear market, the depth of which I could only guess at, say 29 to 30k on the Dow, which remains the trend trajectory. And now once the target stocks fell by typically more than 30%, some even 40-50%, I have been accumulating. So what if I'm buying AMD at 85 instead of 75? Some try and think you can buy the bottom. You're not going to buy the bottom. That's a recipe for owning nothing. That's a recipe of not being invested in anything, because you only see the bottom in the rear view mirror. It does your head in, I tell you. It does my head in, because they don't know what they're doing. They need to chill, calm down, just take it a notch lower and understand that one is investing, not trading swings. You're not trying to blooming swing trade, buy near the bottom and sell near the swing top, which is it's these platforms. Okay, that's my rant, but it's the platforms. They encourage over trading, short termism, eToro, free trade, and the trade to lose, trade to win, trade to turd. They encourage short termism, over trading, and that's what's the problem. You need to go with a broker that charges you a commission, so it reduces your propensity to trade. That's the likes of AJ Bell, they charge, £5 and 0.75% for FX fee, but that discourages over trading. Encourages you to, take your time. Commission free trading encourages you to over trade. You don't win. You don't make anything with these platforms because you're over trading. you're eager to buy, eager to sell instead of accumulating when cheap. There is no benefit. And that's my rant over. And this analysis was first made available to patrons who support my work. So for immediate first access to all of my analysis trend forecasts, then do consider becoming a patron by supporting my work. For just $4 per month, that's nothing for what you're getting access to. And you get access to my most recent analysis and in-depth analysis with my US housing market mega analysis brewing. Analysis that concludes in a detailed 3-year trend forecast for UK house prices that was first made available to patrons who support my work. So for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for just $4 per month. And my UK housing market analysis will soon be followed by my even more extensive analysis of the US housing market that also concludes in a detailed 3-year trend forecast, which is at a time of maximum price uncertainty. Even the Fed does not know from one meeting to the next what they're doing. Like barely days before the Fed hike rates by 0.75%, the chairman Jerome Powell was saying that 0.75% hike was off the table, which illustrates the degree of uncertainty out there. And also access to my most recent ongoing analysis geared towards capitalizing on this stock's bear market that I warned to expect last December. Capitalize on by accumulating AI tech stocks at deep deviations from the highs at target buying levels, which again first being made available to patrons who support my work. So do consider becoming a patron. I support my work for just $4 per month, gaining access to over 35 years experience, right from before the 1987 crash straight through to this stock's bear market that will ride the quantum AI megatrend into the future.